Gabrielle, it's a pleasure to have you as my guest. Welcome to the J Curve.
Thank you, Olga, for inviting me. It's my pleasure.
You have the most incredible story ever. You've been living and traveling and working, operating across many different markets, and you've brought a lot of new practices and new approaches to investing here in Brazil. So, before we dive into all this approaches and successes, I wanted to talk a little bit about you, your personal and professional growth. What were the most important stages for you to get where you are in life today?
I say I'm a little bit of a nomad. I was born in a small city in the countryside of São Paulo, about 80,000 people. And then I moved to São Paulo for like a year. And then I went to live in a farm for a big chunk of my childhood. And then back to São Paulo, moving around, I kind of got a taste. My mom always said I had wheels on my feet. From a very young age, I started studying abroad and living abroad and then working abroad. I've lived in 7 countries, 10 cities. 24 different houses. I had most of my life inside of a suitcase. That kind of shaped a lot of the things that I did after that.
How did you learn to adapt to different cultures?
I think it comes from starting early. I did my first exchange program by myself at 12. I spent 2 months at a host family in the US. I literally stopped at a shop that sold exchange programs, got back home with the little file filled, looked into my mom and said, there's this program during my vacations and I would like to go. Here it is, you need to sign. It was a big group. There were maybe 30 Brazilians together, average age of 17 to 18. And I was a 12-year-old girl sitting there. I did a bigger exchange program at 15, small town in Wisconsin, 2,000 people, almost border with Canada. From then on, everything to me seems like the adaptability just comes naturally. I like the idea of new. And every time that I got an opportunity and I saw something and I'm like, okay, that's a challenge, and I would just jump into it.
How did you end up in Southeast Asia, in Singapore and Philippines? And how did your relationships with Rocket Internet come to be?
So I think everything in my life just came naturally in terms of opportunities. I never quite planned how my career would be and what the next step would be. But then, through relationships that I build, opportunities kind of showed up from Endeavor through Criatec and then Rocket and everything else. So the story in Rocket is I'm finishing my MBA at LBS, thinking about what is the next step. And at the time, my now husband, then boyfriend, was living in the Philippines. He was an expat in the Philippines. And we were talking about, what are we doing next? Are you coming to London? Am I going to the Philippines? Are we coming back to Brazil? Are we going somewhere else? He was an expat for a multinational. We could have gone somewhere else. So I started looking in a very broad perspective what the next step could be. And then I had a call from an MBA friend who actually needed help with some things in Brazil and context in Brazil for Rocket Internet. He was working for Rocket. We were chatting on the phone, talking about Brazil. And then casually he mentioned that he is in Singapore. And I'm like, oh, interesting. If you know of anything that's happening around Southeast Asia, I might be interested. And at that time, they were launching Lazada in Southeast Asia. So he put me in touch with the head of Southeast Asia for Rocket. And then I had a chat with Rafael, a couple of interviews, and then an interview with Ollie. And then I got an offer to become an MD and a founder for Lazada Philippines.
For those who don't know, can you explain what Lazada was and what
Yeah.
Lazada grew into?
Yeah, so it was 2012, probably the height of Rocket Internet. They've been growing businesses all around the world and doing extremely well with a few of the investments. And for those who don't know Rocket too well, they became the clone factory. They were basically getting great ideas on e-commerce and replicating it in markets that didn't have those business models. And one of the business models that Rocket was looking at that time was Amazon's model, which was, the e-commerce for all. And Southeast Asia was really, really behind in terms of e-commerce.
Right now sounds crazy, right?
It does sound. And I mean, it was 2012. We had Amazon going on, I don't know for how many years already. And everybody in the Western world completely already into e-commerce and online shopping. And then we got to Southeast Asia. And Philippines, the only kind of e-commerce that they had was an eBay platform, which honestly, I think about 80% of the transactions that happen on eBay, they actually became physical. people would literally meet. It was a little bit more Craigslist than it was eBay. They would find the product and meet at a gas station, exchange money for the product, and go on with their lives. That was the challenge. And again, e-commerce started growing in the region. We got a lot of investments during the period that we were there, where Lazada grew very fast, and it was bought by Alibaba in 2015. And the e-commerce operation of Alibaba in Southeast Asia today is still
And
Lazada.
it became first unicorn from Philippines. Well, it became a unicorn,
It became
right?
a
Before
unicorn.
it
I'm not
was.
sure if it was the first, but there's a good chance, actually, now that you're saying there's a good chance. I don't think we had the term unicorns back then.
I remember using Lazada in Singapore because I was in
Yeah.
Singapore at the same time and realizing that Lazada got the local mentality of people in Southeast Asia much better than Amazon did, especially this cash piece, because people did not trust online transactions.
Yeah.
They kept their money under the mattress back
That
then.
was really tricky. At the time, like 2012, Philippines had very low bankerization. And I think the credit card penetration was around like 15%. So honestly, I think that was definitely one of the biggest challenges because literally we sold from screws to refrigerators to fashion to anything you can think of, Amazon. And then you had to deliver those things in the Philippines, which has, I don't know how many thousand islands, 7,000 islands, with an extremely difficult logistics. Sometimes transferring in boats from trucks to boats to get in there. And with a low credit card penetration, and there was no boleto or Pix like we had in Brazil, which solves a part of the problem in terms of payments, we needed to do cash on delivery. And that's tricky. How do you set up a cash on delivery operation on that scale? So we had to build a partner in the Philippines who would actually have their delivery people come into your house, knock at your door, give you the product, get the cash. There were many risks involved, the cash disappearing halfway through, robberies or anything of the sort, controlling that money. I think in the beginning we did probably at that range, like 70% of everything, 70 to 80% was cash on delivery. And setting that up and making that work on the operational perspective is absolutely insane. We at the time had a partnership with 7-Eleven. So we had pick up drop off situation in which people could get their product in their local 7-Eleven and pay. And now the pick up drop offs are getting very popular. Mercado Libre has dozens of them in here.
Amazon has them a lot of them in the States.
In the
too.
States. I mean, they're not getting cash on delivery here. You're paying credit card. And the whole thing of the cash payment, it brings a whole new challenge, which when you pay, when you're buying, that is final and definitive. When you set up something and you buy something and you wait for cash on delivery, sometimes you almost forgot that you actually bought that thing. And then it shows up at your door and maybe you don't want it. Or maybe, we send it to the pickup delivery place and the person just never shows up. And all those things were really difficult to navigate.
It's a crazy experience, crazy roller coaster, new culture, new market, new business.
I had the advantage of
Rocket
the not new
Internet.
language because the Philippines is full business English. I did feel more sorry for the other founders because if you go to Thailand, Indonesia, Vietnam, Malaysia, which were the other countries operating Lazada at that time, they had the language barrier. I remember going to the Thai office and having like 400 people in the Thai office, and about 15 of them spoke fluent English. And they actually went around helping the founders communicate. And I can't imagine what that challenge would have been like. But in the Philippines, we had this great advantage that everybody speaks perfect English. Contracts are drawn in English. And in terms of culture, Philippines is a Spanish colonized country. So they're mostly Catholic. And they have a little bit more of like a westernized kind of culture to them versus a lot of these other countries, which are more Southeast Asia rooted.
Wow, I actually didn't know that. I thought they were all pretty Southeast Asian culturally. When you look at that roller coaster type of experience in Rocket Internet, what were the key learnings that you took with you in terms of execution, operations, whatever else? And what do you think in general made Rocket Internet model so successful?
Well, I think starting with the last question of what made it successful, I think the great idea in there, in which I truly believe, is that you don't necessarily need to reinvent the wheel to be successful. And Brazil is the case in which I think that is very true. that you can take inspirations from countries that are a little bit forward in terms of technology and have already taken such opportunities. And those great inspirations can help you set up very successful businesses. Starting businesses from scratch, from brand new idea, like never been done before, is a really big challenge. But when you have effective and proven business models in a place, and then you see that some other places, or most of the other places, Rocket had operations in Southeast Asia, in Africa, some in Latin America. When you see that those places aren't quite there yet, but are just at the brink, and you have the answers already, or, a part of the answers. Of course, when you get on the ground, the challenges are very different, but you have part of the answers. I think that's a very effective models for startups to be built and grow. And in that, like I learned from Endeavor, that was kind of the motto from Endeavor for quite a bit of time. Because Endeavor was founded basically by the guys from Garantia, 3G, they were the guys that brought it to Brazil. And they had a lot of that mentality of like, don't reinvent the wheel. Find something that has an opportunity, that already has a business model, execute it well, and that will be a great business for you. And that's what Rocket did. They saw it in skin, right? Because Oliver copied Groupon with City Deals. Groupon came in, bought City Deals. And that's when the light bulb hit. And he's like, I can do the same thing that I did with this and replicate it in other places. And on the first question, I'm going to need a reminder now.
It was about your main learnings out of that
the main learnings on Rocket. So I think that might be one of them. I do think that taking inspiration from other businesses can be helpful and can help you scale a little bit faster. I think they were very focused on getting the business off the ground. And again, in e-commerce, if you're just a small guy, some other guy is going to become bigger than you and he is going to take the market. So in those specific businesses, scale is important, speed is important. You need to be fast going in the market. You need to be fast taking the market. You need to be fast establishing yourself in the market. And operationally, you need to be very sharp. Rocket is obsessed with KPIs. We had a list of, 200 KPIs, and we all had KPIs memorized in our head. And just because metrics were so important for that business. How successful is your marketing doing? How successful is your delivery? How are returns going? What are rates of conversion? All of this are data that would definitely help you make decisions. And I think maybe that's the second learning. Sometimes people overlook data. And I think having data and lots of data on everything is essential for you to be able to make better decisions. The not so positive learning that I think it has a lot to do with what we've seen kind of happen in the market in 2021, 2020, and the consequences in 2022 is that Rocket was probably one of the first that had this obsession with top line and growth. The bottom line in terms of numbers was much less relevant. And at that time, again, maybe even for the business models of e-commerce, that they needed to be big and they needed to be the incumbent in the market, it made a little bit more sense. But that was something that always kind of bothered me in the whole story. This complete obsession only with the top line. And I think we saw the consequences of that happening 10 years later. But I think Rocket was one of the precursors of the companies that had this obsession with top line, did bring in a lot of that culture into the ecosystem. That maybe was one of the other learnings, especially now that I'm working with debt. I'm much more focused on financial numbers of the company and not looking at just your customer acquisitions and your sales and scaling.
I would want to talk about that and go in details. But before that, one of the things that always fascinated me about Rocket is that a lot of founders in Rocket came to become successful in different types of businesses, different types of markets. So what do you think are the definitive traits of people worked with Rocket companies and scaled their businesses and went on to start their own successful businesses, including yourself?
Well, I think the first thing is it takes a certain type of personality to survive in Rocket. Okay.
Tell me more about that.
So, I mean, it's 20-hour days. It's a lot of pressure. So people who actually stay, they're definitely hardworking, definitely smart because they choose people from specific places. They're very criterious on the people that they choose. They are very quick at firing. You don't hear about all the other ones that were not successful because they're not even putting it on their resume, because if you don't adapt to that pressure and to that standard, they're very quick on making decisions of firing and substituting people. So I think people that do end up surviving for a certain time in Rocket are naturally resilient people. And the other thing is, I always said that working for Rocket was like being an entrepreneur on steroids. Because the reality of most entrepreneurs in the world is you start this business very small, and then you get the seed round of, like $1 million. And then you work hard to get your prototype ready. And then you work hard to get your pre-Series A money, another 3 million. Like there is, a stage in which you scale that. And in Rocket, I think one of the biggest assets in Rocket was just honestly, how brilliant Oliver was at raising money. So the amount of money put into these companies in such a short period of time, like for me, it was 2.5 years experience in which I saw a company from literally zero. Like we didn't have a website live. We barely had employees. We had no contracts, no suppliers, no warehouse, no anything at the point, to literally hundreds of millions of revenues, because there was so much money pouring into these companies. And that mentality of growing it so fast, it gets you to experience all the stages of a company in such a short period of time. So I think in terms of a learning experience, it's very hard to find parallels, just because it takes you from 0 to 100 in such a short period of time. And for that, you need the adaptability of working on a company that had 10 employees to get into a company that had 800 employees in that short period of time. And that is not the same company. And you don't manage that company the same way. And the challenges are not the same. So you start with the challenges of the startups, and then you end up already with challenges of a large enough company becoming more corporate. So I think the combination of the people that survive in Rocket with the experience that you can get at Rocket, if you manage to survive, it's a pretty powerful combination.
How did you come from that experience of being an entrepreneur on steroids to becoming a precursor, essentially, to venture debt in Brazil and in Latin America? How did that magic leap happen?
I came back to Brazil on a very, very personal decision, on a mission to not live off a suitcase anymore, moving countries every 2 years. So I was back to Brazil. I had just had my first child. And I had worked before in Criatec with Francisco Jardim, who you know from SP Ventures.
Great guy.
Great guy. And he was the regional manager for Criatec, and I was working at the national office for Criatec for a few years. So we knew each other very well, and we always talked about trying to do something, but the opportunity kind of never showed up. So he calls me one day. I have like a 3-4-month-old baby. And he's like, we're talking about this thing, like we have this project that we're looking into that is doing venture debt in Brazil. Totally honest, never heard of venture debt before. It was like a 8 p.m. call in June, July. I was at the beach and I'm like, I have no idea what that is. Well, he started explaining a little bit what venture debt was and what they wanted to do about it. And I'm like, okay, give me a little while. Let me research. Let me figure this out. And then I started understanding what venture debt was, why it wasn't in Brazil, where the opportunities were and weren't. And I had a number of chats with him. And then he actually invited me to head the project. And it was a long project. It involved like a bid with BNDES, which is our national development bank. And those things take time. It takes a while in terms of due diligence. And then we had to build the first bylaws of the fund, regulamento of the FIDIC that we have. And that took another time because we didn't have a model, because nobody had done a venture debt fund before. So that went on, and then we started fundraising, and then I had another baby. And again, it's one of those things that no substitute for luck. The fund actually got that closing by the time that my second daughter was 7 months, and I could fully dedicate to the project. Because if it had closed 7 months before, I would have had a newborn. That would have been a challenge. So we started this project officially, like we fundraised at the first at January 2019, February. We did a second closing on June, July 2019, and we closed our first operation in August 2019.
This story is fascinating. What was your fundraising pitch? What did your fundraising pitch look like when you raised for that first closing?
So the venture that thing, we needed to first develop a way in which we thought was a successful way of doing venture that in Brazil. So equity is a much more broad and a much easier thing for you to do cross borders, just because generally laws for equity cross borders, they're more unified, they're more simple. So you can do different things in different countries and use almost the same instruments. Debt is a whole other situation. Every single country has very different laws on how they deal with debt. What is valid, what isn't valid, and the legislation is an issue, but then the judiciary is also an issue. In Brazil, there's one thing which is written in law, and then there is what actually happens in practice. And understanding all of that was really important for us to figure out a way to do this sustainably. So we definitely couldn't copy the model from the US. We needed to create a model that would fit the Brazilian debt market. So when we were pitching and we were fundraising, we were selling this product that we already had metrics of what we were going to do. And then the US had so much data on venture debt. And the history of venture debt in the US is extremely successful. I mean, it's 40 years working in the market. It represents every other year between 20 to 25 of all the money that is raised by venture companies. So it's a quarter of the money. And then the returns in the US are very decent. And one of the things that was really surprising in terms of data is that the average default rate for venture debt in the US is lower than SME companies. That was an interesting thing. You're doing like a risky investment. You know, venture is in the name. It's still debt, but venture is sitting there to define that risk. But actual default is lower than average SME company in the US. And that started building the story of, look, here's what we have in the US. Here's why we think this is the right time to come into the Brazilian market. At that point, the interest rates were coming down and the interest rates were much more stable. I think handling a debt product like a high yield debt product in Brazil on a very turbulent interest rate environment, which was what in the previous years, was more challenging. And we were seeing a little bit more consistency in terms of interest rates. So that kind of built the thesis of why that was the right point to bring it in. And again, what is important also is that venture debt does depend on venture capital. It is a byproduct at the end of the day. I always say you don't get companies that grow to billions just on debt. You are going to need equity in there. The debt is coming in to leverage your whole financial structure to actually make the company more profitable for investors, to make them more healthy. But you do need equity. And I think if we were talking about venture debt 5 years before, we didn't have a volume of venture capital investments in Brazil happening that would justify the venture debt in there. So all those things build the thesis of why we were doing it. And it made sense to investors. Again, we got very sophisticated investors and we got people that understood venture capital, understood debt, kind of understood what we were doing in that sense. And that was enough for the pitch. We got a few big investors, very focused on VC, a few larger investors in assets, a few family offices.
So you mentioned that venture debt is the byproduct of venture capital, that I absolutely agree. But at the same time, profile of companies that can raise pure venture capital versus those that can complement the equity with venture debt is very different. So how do you think about that difference? And what are types of companies, types of startups in terms of business profile, whatever metrics that you track and stage, that are more qualified for venture debt?
So I think the first thing, absolutely stage. If you're in a seed round, if you're a small company, still venture debt is not there to take risks of proving a thesis. Proving a thesis is exclusively area of venture capital. Because when we look at debt, I want a company that has proven that they can do something and that now they want my money to do more of what they already do well. So it's less about the size. The size, of course, gives me a little bit more of a feeling of how the market is accepting the company. And I want to have a little bit more data in terms of, history. So those things matter to me, but it is much more about business model. I need companies that already have very healthy economics. I need companies that can retain clients. I need companies that have good customer service, that have a product that I understand makes sense to those clients. And again, we're not at the stage of getting a feeling that that is a good product, or I'm not also going to call 3 clients and have a feeling that it makes sense for them. I want to have data that you've had so many clients for so many years, that you have a low churn, that they do stay, that you can upsell, and you are keeping those customers happy. So I want to see that data. A lot of VCs goes into the idea, goes into the founders, the ability of the founders to execute. We in debt, I like a little bit more data that proves that that problem has been solved. And then after that, we're sector agnostic. But of course, we have a few preferences and we have a few things that we do value. The first thing that we do value, I think we do value a VC investor in there. The reason why we do value a VC investor, so first thing, it comes to governance. If you're giving debt, I would like to have a company that has a level of governance, that I know that there's oversight and there is a structured decision-making process. And of course, VC investors bring that into the companies. And that is very reassuring on a debt perspective. The second thing that we look is reliable revenues. So recurring revenues have a few extra cookie points. When we have non-recurring revenues, we need to have a few more things that would compensate for those non-recurring. And then, of course, we look at everything else that the VC does. We do look at the quality of the founders. We do look at the size of the market and the opportunity. We look at traction, look at all those things in the company. So I always say that the job that we do is probably like 70% equity analysis. And then we got like a 30% that's kind of a sanity check. So I would say that is the kind of mentality of how we look at it.
So, Namari, the
Yeah.
former Nila,
Yes.
is your second entrepreneurial venture in debt.
Mhm.
How is that different from the first one that you launched with Francisco?
Yeah.
How the strategy evolved, and what are you excited about as a venture debt investor in the environment we're in today?
Yeah. The decision to go and found Nila, now currently Namari, came from that entrepreneurial side. At that point, when we were thinking about the second fund, it kind of made sense to me to have my own asset and have more independence on where I was going. So we decided to almost spin off or something of the sort. The team that was handling Brasil Venture Debt into Namari, we made a deal with SP Ventures that we still handle Brasil Venture Debt together. We have our specific responsibilities the same way that we had when we were inside. And I think that was really important to begin with, because our main responsibilities is still to investors. So we wanted to keep committed with the whole team into getting this fund to the end, which is July next year. And then we looked at the opportunity and we started fundraising. I had a new partner that came in and that was an anchor at our fund and became a minority investor in Namari, who's Alchemy. So Alchemy is a large house that basically does high yield debt. And Urbano, who's the founder, is a really, really experienced debt guy. He brings in 20 years of knowledge of that in Brazil and helps us a lot in terms of how we structure them and how we can protect and how we can set that up. So I think that's mostly what influenced and what changed, is that we have a closer partnership with a debt partner that gives us perspectives on other things that maybe we hadn't seen in the debt market that have a fit with the ecosystem of venture capital, and those could become products that we can offer to entrepreneurs and to companies. And the mentality that we have is that we feel that Namari is this house that understands debt, understands the ecosystem, can understand startup companies. And what we want to do is provide non-dilutive capital to those companies. The way that we do it and the structure that we have in the fund today is very open. And we've looked at everything from reorganizing cap table, doing cash outs for a certain investor that is about time to get out, or an angel that wants to get out. We've done M&A operations. We've done financing of sub-quotas in Fijikis. We've done, well, the most traditional would be a runway extension. But we look at everything. And I think a bit of the mentality that we have is that, again, we started this product in 2019. It's very young. And we're very conscious that we haven't found all the answers. So I believe we have a good product today, but we don't stop growing that product. If we assume that with the 4 years that we've been around, that we already got the product perfect and that we have all the answers, we are going to fail. Somebody else is going to find and look for different answers and is going to come up with a better product and better answers. So I have this very intrinsic thing within the team of like, don't settle. Let's not settle and believe that this is already done and that this is already perfect, because I'm sure it isn't.
Your level of adapting to uncertainty and consistently grinding and creating and not settling is unbelievable. And I think it's a huge part of your personality and a huge part of all the success that there is today. In terms of the next decade, what do you think are the factors that will influence the future of Namari and the future of debt market here in Brazil?
I think the first thing is we're coming out of a very turbulent last 12
What is like 13% interest rate?
13%, 13 point something. It's
a lot of percent.
Yes. It's above 13. So the last 12 months was very impactful for the whole thing, right? So first you have the VC crisis, the valuations coming down, and I think everybody kind of rethinking a little bit how companies are. The consequences of that are very positive for us in so many ways. So the first thing, I think there is a short-term consequence, which is the market is short of money. The valuations are way down. Of course, companies still need money to grow, and we can provide that. Good companies that still need money to grow, but are not willing to go into a down round. I say, equity is marriage. Debt is only an engagement. It's a less long-term decision. So getting a bad decision on equity right now is definitely the wrong choice. I don't believe quite that there isn't money. Funds are full of dry powder, but they're not getting it out in the market. They're very conservative on where they're investing. That's the first thing. Second thing, which I think is the best thing that happened to debt in a very long time in the system, is that shakeup in terms of availability of money and the valuations brought a whole new mentality to startups. The thing that we were talking about Rocket before of thinking about top line and growth at all costs had a really big shift. It's not how any company out there is thinking about right now. Every single startup company in the world right now is somewhat worried or very worried about their operational numbers and how operationally efficient they are and proving that they can be break even. Of course, they're going to prove that they can be break even, then they're going to raise money and they're going to burn cash again. But it is bringing that mentality to companies. And I think that will bring a vintage of much, much healthier companies. That is easy. Because lending money and lending venture money to, all spending huge cash burning companies, it would be one of the things that would make me worry at night. I would much rather go for a company that has slightly lower growth rates, but that does show consistency in terms of their bottom lines and operational efficiency.
In terms of consistency of operational efficiency, is there any minimal growth rate that you still expect the companies to hit?
Absolutely. Desirable would be at least 50% a year.
Okay.
Less than that, we'd have to have a really good story of an inflection point and why that would happen now. But that would be what we see in most of the companies. I think last year, the average rate of growth of our portfolio was like 92%.
And we are talking about portfolio that has already sustainable business model. It's
Yeah,
not the
and
growth
larger
pre-product
companies.
market.
We have companies on the 200, 300 million revenues range.
Before we move to rapid fire, I have to ask this question about the favorite baby.
Oh,
So
that is an extremely different question of the favorite baby.
so when
Love
you look
all
at
my
your
children, you know. We love all of our investments. I think it did great investments all around. But I don't know, maybe if I can come up in here, I don't know if you ever heard of a company called Solubio.
No, I didn't.
So,
What do they do?
so Solubio basically does biological control in agriculture. So they have a small machine that they set up in the farm and they send you the supplies of biologicals and you set up the right mix for you to do your biological control in crops. And the story with them, and I think why I like them, they got a round of investments from a private equity now last year. But before that, they were kind of this company sitting in the countryside of Brazil, growing by themselves with very down to earth entrepreneurs and this history, which I think we sometimes overlook in terms of innovation, is just not in the tech world, sitting in Faria Lima in Sao Paulo, in Florianopolis, but there is so much innovation going on around Brazil. And it's hard to assess, like you don't really necessarily find those companies easily, but there is so much out there. And these are companies that have been bootstrapped for years and that still manage to grow and create extremely innovative products and actually change the markets that they're in without even getting up into the VC world that we know. So now they got private equity. They got a big investment in private equity. They're quite large by this point. But when we invested in them, there were a small company. They were about a year and a half old, maybe. Beautiful contracts, huge contracts with huge buyers. Proven model, very consistent team, this down to earth entrepreneurs that you kind of have this feeling of they can handle difficulties. They can handle the ups and downs, and they've had ups and downs in their careers and their lives before.
I love the example. Okay, let's move to the rapid fire. I'll ask you 5 short questions and I'll appreciate your immediate responses. Let's dive right in. The first question is, what's one piece of content that every founder should consume?
So there's an old book that's called Financial Intelligence for Entrepreneurs.
I've never read that.
It's a 2008 book. It's a book in counting and KPIs of companies and understanding what a balance sheet means, understanding what a cash flow statement is and what should be in there. And honestly, I think if you're starting a company, every single founder should read that, because you find so many founders that kind of rely everything to a CFO. But if you're the owner of a company, I do feel that you need to be very versed on those things. And that will make great changes on how you think about the business, how you understand the business. You do need to know your numbers. And I think that shows the first things for me in founders. If I have like a first call with a founder that doesn't know their numbers well, that for me is a big downgrade, right? It doesn't matter if you're a CTO, if you are a CMO, if you're a CEO, you own that company. If you don't know how that company is doing financially, if you're burning cash, if you're not burning cash, how much you're growing, I mean, it's your business. So I think, everybody should have that basis. It's not a very advanced book. It's not a book for your professional CFO, but it is a book that will help you be able to have those discussions in a level that I think will bring value to companies.
I'll definitely read that because numbers always scare the shit out of me. My brain was not designed to read Excel, but I do believe what you're saying is correct. You really need to understand the health of your business, and you cannot do that without numbers. Question number 2, is there any popular entrepreneurial advice that you strongly agree or disagree with, and why?
So I think from Rocket history, one of the learnings, and I do believe in that, fail fast, fail forward. Try something, doesn't work, don't have an attachment to it. Get the learnings, use your whole growth mindset, and just move on. We see so many companies that have product that they've been struggling for like 3-4 years. And it's not growing enough. not really disrupting anything. They're still burning cash. You need to create that detachment to be able to make the right decisions.
Fail fast, fail forward. Yeah, it's really hard to get rid of the concept of the sunk cost,
Yeah.
when you invested so much
Very
already and you're
difficult.
just going. But then again, that connects to your data-driven decision-making
Yeah.
process. Like connect that to data, look at it, doesn't work, disconnect. It's
It
not
is
a
what it
baby.
is. It needs to be
Not
a
a
rational
baby. It's
decision.
none of your family.
Exactly. Exactly.
So we are writing your autobiography.
Mm.
What would be the name of the book we're writing?
So that's a difficult question. I needed the help of ChatGPT for that one. It gave me 100 horrible options, but I think it came up with a decent one, which is Pathfinder. I like the name. It reflects a lot of, Lazada and Namari and Venture Debt. It's like you're given a blank canvas with a problem that has no solution yet. And I like the challenge of new things and coming up with new ideas and fixing problems that haven't been fixed before. So I think Pathfinder is a good one.
I think it was a great suggestion, but
ChatGPT is working.
If you could snap your fingers and start a different business today, what would this business be? Where else opportunity lies for you?
Yeah. So I was at a Distrito event for chief innovation officers. It was a more specific, more in-depth technology kind of presentation, but had a few topics that I thought were interesting. So I went to watch it. And one of the guys was giving this thing about cybersecurity, showing what the risks are and everything else. And there was a number in there that kind of really shocked me, which is that by 2025, the financial damage caused by cybersecurity breaches would be the third largest economy in the world. It's estimated to be $10.5 billion.
Oh, that sounds like a $10.5 trillion opportunity to me.
Exactly. And then previous to that, a whole lot of the discussions permeated on AI and the opportunities of AI and how everybody's using AI. But I think we're hearing very few discourses of people who are going to protect the world from AI. And how are you going to protect systems from AI and how AI will impact and how AI will disrupt cybersecurity as it is today and how you need to improve structures in cybersecurity to actually counter AI. Like we're hearing all about the opportunities, but we're not hearing about companies actually building themselves up and getting ready to fight the risks that will come with it. So I think that would be like a massive opportunity at this point.
Okay, last question is my favorite one.
Yeah.
If you were an alcoholic beverage, which beverage would you be and why?
My favorite drink is whiskey sour.
Ooh, okay.
A little sweet, a little sour.
And knocks
strong,
you out.
Very strong, but you don't notice at first. You start having the first sip and you know it's sweet and it's got the lemon, but it's got a lot of whiskey in there. So it is a strong drink.
Gabriela, thank you so much for being my guest, for sharing a breadth of knowledge and experiences, and for being that genuine and that humble, because what you've achieved, I don't know, globally, a fraction of women managed to achieve. So it's great to see this type of leadership example here in Brazil.
Thank you very much for the invite and thank you for the compliments, but nowhere near that yet. There's so much, there's way more to come to get there still.
Sky's the limit.